Time for the latest earnings outlook now with Research Director Shiraz Mian. So we're in the last phase of the Q4 reporting season now, Shiraz. Give us a quick recap of that scorecard.
Yes, I have a scorecard for you to share with you. We have 389 S&P 500 companies have reported as of this morning, 111 still to go.
This morning, February the 13th.
That's right.
Okay.
As this chart shows, I won't go into the details. The first column basically shows the percentage of companies from each sector in the S&P 500. We track 16 sectors, as you know. So 84.9% of the market cap for the index have reported 10.5% earnings growth and 0.6% revenue growth. 69.4% companies beating earnings, 62% beating revenues. Just a brief comparison for these growth rates relative to growth rates for the same group of companies in Q3 and the 4-quarter average through Q3. As folks can see, the earnings growth rate is materially better than what we saw from the same group of companies in Q3 as well as the 4-quarter average. The revenue growth rate stands out for weakness, but there is a couple of one-off things on both sides. On the earnings growth side, there's easy comparisons for a handful of companies, particularly Bank of America, Verizon, and Travelers. Once you strip that out, the growth rate falls, but still remains better than what we had seen throughout 2013. On the revenue side, once you strip finance out, particularly Prudential Financial, which had a big one-off gain in Q4 12, the growth rate improves a bit, but still remains weaker than other quarters in 2013. So stepping back, the growth rate is better than what we had seen in other quarters in 2013, and the beat ratio, the ratio of companies coming out with positive surprises, is also better than what we have become accustomed to in 2013 as a whole.
But guidance, a little problematic, right?
Yes, it is. And nothing really new on that front. Many of us, I won't include myself in that camp, but many on the street were expecting guidance to improve because of how the U.S. economic outlook had improved, how Europe had stabilized, and all of those things. We did not see that.
You were always skeptical.
I was always skeptical, and we see continuation of the negative guidance trend that has been going on for more than a year now. But we saw last evening, Whole Foods had good numbers but guided lower. A few days back, we saw that with Deere, Boeing, and a whole bunch of companies who came out with good numbers for Q4 but guided lower.
You have a graphic for us on the guidance situation?
Yeah, the guidance situation. I have a graphic which mimics the evolution of estimates for the current quarter. So as guidance has been coming out on the negative side, analysts covering companies have been cutting their estimates for the first quarter, and you see that at the beginning of January, the expectation was for earnings growth for the S&P 500 in Q1 of 2.1%. As of this morning, that has fallen to negative 2.2%, so a complete flip in terms of expectations for Q1.
So what you're talking about then is continued deterioration in that guidance as we get through into the Q1 season.
Absolutely, a big chunk of the remaining companies that still have to report are from the retail sector.
Yeah.
And
we just got retail sales out too.
We got retail sales out this morning, and they were very bad. Not only was January bad, but December was revised down. And all sorts of bad data is blamed on weather. And we know if anybody is good at blaming weather for bad numbers, it's the retailers. So about half of the retail earnings reports are still awaited. A number of them have pre-announced already, but I would expect those folks to maintain and maybe even accelerate the negative guidance trend we have seen thus far.
So what are you looking for Q1? You want to go out on the limb at this point?
You know, the expectation is, as I mentioned, the 2.2%. Here is the complete picture, which shows Q1, the 1Q14E, negative 2.2% earnings growth, which would follow the plus 9.2% growth in the Q4 2013. I think it'll go down some more. I wouldn't be surprised if the growth rate falls to 2.5%, 3% negative by the time all is said and done. Estimates for the rest of the year are also coming down. So the big question now on the earnings front and on the macroeconomic front is, are we passing through a soft patch brought on by unusually negative weather, or this is something more enduring? And the positive momentum that we saw in the second half of 2013 was actually a blip. So once that question gets resolved, that will have a bearing on the earnings picture as well. But overall, the earnings picture isn't as good as one would expect from the market's very strong performance in 2013 and 12.
Okay, thanks for that. If you're not watching this video at our website, Zacks.com, then you can get on over there. And Shiraz also pens a periodic earnings trends commentary for the website that you'll find. You can link to it right off the homepage. There's the earnings preview that shows up every Monday morning on the homepage that kind of clues you in about what's expected earnings-wise for the week ahead. And then the day-to-day commentary that he provides in Ahead of Wall Street, all on Zacks.com. So if you're not over there watching this video, get on over and check it out. With Shiraz Mian, I'm Terry Ruffalo.